Good afternoon, everyone. Welcome to this webinar on navigating the income tax bill, which has just been tabled in the Parliament. I am Bija Rajinkya, a partner with the Direct Tax and Private Client Practice at Khaitan. And joining me today are my fantastic colleagues, Ritu, who specializes on international tax and M&A, and Raghav, a specialist on domestic tax and tax litigation. So, in today's discussion, we will be talking about the background to the income tax bill, certain developments on the international tax and transfer pricing side, corporate taxation and tax disputes, certain amendments to the non for profit organizations, navigating the transition to the new law, as well as the way forward. Let us look at a brief history of the Income Tax Act. And in the colonial times, we had the Income Tax Act of 1922. 40 years hence, post independence, looking at the changing political, social, and economic times, we had a new income tax law of 1961, which replaced the Income Tax Act of 1922. Over the years from 1961 Act till date, we have seen 4,000 amendments and 65 times that the law has really changed. So if we see this brief period of around 62 years, almost every finance act which was tabled in the parliament in the year in Feb or March of every year, we have seen changes to the Finance Act. And now we come to the new income tax bill, which is just being tabled and expected to be passed in the monsoon session of the parliament. Interesting to note that around 10 years ago, there was a talk of having a new direct taxes code. However, for a number of reasons, that was not really taken through. Looking at the new income tax bill, and what are we really looking at in this particular situation? One, I would say that important to note that there are no substantive changes in the new income tax bill. It's only meant to serve a purpose of simplification as well as to improve readability, because as we see the law today, there are a number of subsections, clarifications, explanations in the law which does not make it as reader friendly. Interestingly, the concept of tax year has been introduced, which replaces the concept of previous year as well as assessment year. There is a reduction in the volume, and it's almost half from the previous 1961 Act. So definitely great for lawyers and tax advisors alike. They've tried to use simple English. Of course, there are some grammatical issue, errors, etc., which will get ironed out as the income tax bill is actually placed before the parliament. Very interestingly, so as to make it reader friendly, they have provided for a tabular representation of the various deductions, exemptions, etc., which are available in the tax law. The explanations and provisos, which were often introduced every Finance Act, especially given any judicial pronouncement which really took place, have now been converted into subsections to the main section itself. So if we really look at the overall view of the income tax bill, it really addresses these 5 point items. Moving on, I would now request my colleague Ritu to talk about the international tax and transfer pricing developments as have been provided in the income tax bill. Over to you, Ritu.
Thank you so much, Bijal. So there are a couple of noteworthy changes in certain international tax provisions and transfer pricing related provisions. So let me start with a simpler one first, and then we'll move on to more interesting ones. So first is payment of royalty between two non-residents. Currently, under the Income Tax Act as well as the Income Tax Bill, we have deeming source rules. Why those are important? Because for non-residents, income that is sourced from India or deemed sourced from India is taxable in India. And one of such deeming source rules deals with royalty payments between two non-residents. So when a person paying royalty, a non-resident paying royalty to another non-resident, involves a situation where the underlying IP rights, the intellectual property rights, are being used by the payer in relation to its Indian business or for earning any income from India. In such case, the royalty is deemed as sourced from India for the non-resident receiving the royalty. So interesting to see how a payer's factual pattern decides the taxability in the hands of the recipient. And this is purely under the Indian domestic tax law. Tax treaties have a different test. Now, what the income tax bill says is the condition is pretty much the same, just that the income tax bill's drafting reads as that when a non-resident pays royalty to another non-resident, where the underlying IP is used for earning any income from outside India, that's deemed as sourced from India and taxable in India. Now, this is, of course, clearly this is a drafting error because payment between two non-residents for earning income from outside India has no real India nexus and therefore should not fall within the purview of the source rules. And we hope that this does get corrected in the next term. Now, coming to the next change, which is with respect to forex fluctuation benefit in the context of capital gain income earned by non-residents. Now, currently under Income Tax Act, non-residents are not eligible to claim exchange fluctuation benefit when earning long-term gains from sale of shares of an Indian company. There could be certain circumstances on which one can avail the benefit, but keeping that aside, generally it's not available. And why? Because government has over time rationalized the capital gain tax rate itself and therefore taken away the exchange control benefit. Earlier, the capital gain tax rates were higher and one could also get the exchange rate fluctuation benefit. But now the tax rates are lower, so the exchange rate fluctuation benefit has been denied. In numerical terms, what that means is that if, let's say, a non-resident has invested in shares of an Indian company, let's say 10 years ago, and for simplicity, let's say has invested $1. And currently, let's say the sale is happening again at $1. So purely in USD terms, there is no gain to the seller. But when we compute the gains in rupee terms, there could be a 20 rupee gain because 10 years ago, the rate was roughly 65 rupee per dollar. Today, it is roughly 85 rupees per dollar. So purely in rupee terms, there is a gain arising to the non-residents, which is taxable under current law. Income tax bill interestingly extends this benefit, or let me put it this way, that it doesn't bar a non-resident from claiming exchange fluctuation benefit on long-term gains on sale of unlisted shares. For listed shares, it's still not available, but for unlisted shares, non-residents should be able to avail exchange fluctuation benefit on long-term gains. So quite a significant benefit, and it's a departure from what's there under the Income Tax Act. Now, it's yet to be seen if it's really intended, or is it because of some drafting error or misses. So we will see in due course if it's really intended, or will they plug it in the next turn of the income tax bill. Next slide, please. The next and a more important topic is in the context of tax treaties. Tax treaties are very relevant for non-residents to explore when investing in India or earning an income from India, because Indian law recognizes that a tax treaty, if more beneficial, prevails over domestic law. So that's why very important for non-residents. Now, what the income tax bill does is, and it's something similar to what we already have under the Income Tax Act, it says that if a term used in the tax treaty is not defined under the tax treaty, then one can rely on its meaning provided under the Income Tax Act, the Domestic Tax Law of India. And if such a term is not even defined under the Income Tax Act, then it could be as per a notification specifically issued by the government clarifying the meaning of that term. So this we have under the Income Tax Act also. What Income Tax Bill does is it introduces two more sources of such defined terms or definitions. It says if a term is neither defined under the treaty nor the Income Tax Act, and there's not even a notification issued by the government, then one can rely on the meaning provided in any other central tax law, which means, let's say, a Goods and Services Tax Act. And if it's not there even under any other central tax law, then the meaning could be as per any other central laws of India. So we have two more tools or sources where we can look at definitions if a particular term is not defined under the treaty. And wherever we borrow the definitions from, it has to fit the context. So it has to be consistent with the object, purpose, and the context in which a particular term is used under the tax treaties. Now, in terms of impact, if we look at a term like beneficial owner, now beneficial owner, again, a very important term in the context of tax treaties. It is used in the provisions dealing with taxability of dividend income, interest income, royalty, fee for services. And the treaties generally say that entity receiving such income should also be the beneficial owner of such income to be able to avail beneficial tax treaty provisions. And this term is neither defined under the tax treaties nor the Income Tax Act. And we have seen a lot of judicial precedents or case laws where tax authorities would want to evaluate whether the entity earning income is indeed the beneficial owner. So it's pretty much facts and circumstances driven assessment. Now, if you look at any other central laws, we do have a definition of beneficial owner in certain other central laws. And therefore, like Money Laundering Act or certain securities related laws. So now it will be interesting to see if definitions from those legislations could be borrowed in the context of tax treaty. So definitely some more assessment evaluation needs to be done, and definitely some more work for the tax advisors to carry out in the context of tax treaty benefits, which a non-resident might be exploring. Next slide, please. So next, I'd like to touch upon some changes in the transfer pricing related provisions. And this is an interesting one, meaning of associated enterprises. Now, this definition or the concept is important because when two entities are treated as associated enterprises, then any transactions between them are subject to extensive transfer pricing requirements, compliances, documentation requirements. Currently, under the Income Tax Act, the definition has two limbs. One is a more general sort of criteria, which says participation of one entity into management, control, or capital of the other entity, or if there's a common person participating in management, control, or capital of two entities, then the two are treated as associated enterprises. Now, this is generic subjective because there's no objective threshold prescribed in this part of the definition. Then there's one more limb to this definition, which sets out certain objective thresholds or conditions. And if those conditions are satisfied, then two entities are deemed to be related parties or associated enterprises. Some examples are where one entity holds at least 26% voting interest in the other entity, if one entity is appointing more than half of the board of directors of the other entity, or one or more executive directors, or if one entity is providing loan to the other entity, which exceeds 51% of the book value of the other entity. So these are the objective tests. And if the relationship falls under any of these thresholds, then two entities are deemed to be related parties. The reading under current law is, under the Income Tax Act, is that the objective tests control the applicability of the general test. So a general test is not standalone. Merely participation in capital control management does not create an associated enterprises relationship. The relationship has to fall under one of the objective conditions or circumstances. So there is clarity under current law. What the income tax bill provision reads as, the income tax bill provision, the way it is drafted, it can be read as the general test and the objective tests could be read on a standalone basis. What that means is that as soon as there is participation in management control capital, can the entities be treated as associated enterprises even if none of the objective tests are fulfilled? And the reading currently seems to suggest that the general tests can be applied on a standalone basis. What in terms of impact that could mean is that even if a 5% shareholder, 1% shareholder, because there is a participation in capital of the other entity, is it enough to result in a related party relationship? So again, we believe that while the intent may have been to clarify the language, but the reading is could result in such wider implications which may not be intended. So again, hoping that this gets plugged in the next turn. Otherwise, it will be subject to interpretations, and the core goal of simplification would not be met if this definition could be read in such a wide manner. Now, coming to the next change under the transfer pricing regime is with respect to arm's length price determination. Currently, there is lack of clarity as to whether when one determines a single arm's length price, is the tolerance band of plus minus 3% available with respect to such single price. Uh, the income tax bill clarifies that yes, even if a single price is determined as an arm's length price, the variation or the tolerance range of plus minus up to 3%, subject to what specifically the government specified, but the maximum range is 3%, then even in case of a single arm's length price, one should be able to benefit from this tolerance or the variation range. So, which is a positive clarification. And if there is more than one arm's length price, then the manner in which the arm's length price has to be determined will be prescribed. So it's the same what we have under the current Income Tax Act. So to that extent, there is no change, but the clarity with respect to availability of this tolerance range when a single price is determined as arm's length price, that's indeed welcome. So with that, I'll now hand over to my colleague Raghav to discuss other topics of importance that we have shortlisted for this presentation. Thank you for being with us so far and your patient listening. Raghav, over to you.
Thank you, Ritu. Now I'll take over some topics and some interesting language-related changes that are there with respect to corporate taxation. Now, first and foremost is the update and the language change in relation to the intercorporate dividend deduction. Now, in the current law, we have a provision which provides that if dividend is upstreamed by a company to its shareholders, then the recipient company or the intermediate dividend recipient company is not required to pay tax on that dividend amount that it receives. Similar provision is there in the new bill also. Now, only thing is that currently there is a regime for corporate taxation. Now, what happens is that there are two regimes. One is 15%, which is available for a new manufacturing company, and a 22%, which is available for other companies. This intercorporate dividend deduction in the current law is provided as a deduction to either of these companies which are availing this concessional tax regime for the 15% as well as the 22%. Now, when we talk about the new bill, while this has been maintained in relation to the new manufacturing companies, uh, for the other companies which are going to claim the 22% rate, this particular deduction is not present. Now, it seems that there are two schools of thought for this. Number one, is it just a miss on the language part? And the other school of thought is actually this might be intentional also. Now, whichever view is actually the correct one will only time will tell when the next round of this bill comes in. But as of now, in terms of impact for companies and organizations which have multi-tier holding structures, they should definitely take into account and be watchful of this particular provision while they are upstreaming their income streams to the promoters or the ultimate level of shareholders. And I'll depict the impact of this with the help of an example. For example, let's say there is a listed company which is giving dividend to its holding company, company A. Under the current law, what will happen if 100 rupees is the dividend amount that we are talking about? Company A will not be required to pay tax on this 100 rupees if it upstreams the same dividend amount to its promoters within a prescribed timeline. In that case, what will happen? The tax will have to be paid by the ultimate recipients, that is the promoters in this case, which will amount to approximately 36 rupees. So the net amount available in their hands will be 64 rupees. Whereas in the proposed law, if 100 rupees dividend is being declared by the listed company to company A, then, and if the company has opted for 22% regime, then the first level of tax will come in company A's hands, which will be, let's say, about 25 rupees. And then company A will have only 75 rupees of profits to upstream to its shareholders, which will mean that there is a higher incidence of tax, because when the amount will go to the promoters and the individual shareholders will also have to pay the ultimate tax, which is in this case of approximately 27 rupees. So the net disposable amount in their hands will be much lower as compared to the amount which would be available with them in the current law. Now, again, whether this is a language miss or is it intentional, only time will tell. But till the time, in the current version, in the current draft of the new income tax bill, this particular intercorporate dividend deduction is not available for a company which is claiming the 22% tax rate. Moving on, the next update or the next change that we are seeing is in relation to the AMT and the MAT provisions, the alternate minimum tax and the minimum alternate tax. Now, as we know, these are alternate regimes which are applicable on corporate taxpayers and non-corporate taxpayers. That is to say that if their taxable income computed as per the normal provisions is less than a specified monetary threshold, then they're required to pay these alternate taxes also. Uh, in the case of non-corporate taxpayers, we have this concept of alternate minimum tax, which is also called as AMT. Now, in the current law, it is applicable on non-corporate taxpayers if they are claiming certain specified deductions, such as the deduction available for SEZ units or the deductions which are available for certain specified businesses, etc. Which means that if a non-corporate taxpayer is not claiming those specified deductions, then the non-corporate taxpayer is not subjected to the AMT provision. Now, in the new bill, the AMT concept is there, but the similar provision with respect to applicability is missing in the new bill. As a result of that, what is appearing is that AMT will apply to all the non-corporate taxpayers, unless, of course, they have opted for the specified concessional regimes which are applicable to cooperative societies. So now, if the current draft of the bill becomes an act, what will happen is that all the non-corporate taxpayers will be subjected to the alternate minimum tax regime, which in the current act is applicable only if they are claiming certain specified deductions. Again, whether it is a language miss or an intentional part or an intentional amendment, we'll have to wait and watch. But till that time, it might have an impact on the holding structures which have got partnership firms, LLPs, and especially the ones which are holding assets for a long period of time. Because as we know that long-term capital gains are taxable at a lower rate, and when we talk about the rate for AMT and MAT, that is a higher rate. So if at all this particular provision gets enacted in the current form and manner, all such LLPs, all such firms, and all such holding structures will might have to revisit the structures because of this additional tax trigger which might come on them. So this is one important update and amendment, or I mean a language change in the AMT regime. The second one is in the MAT regime. Now, what it states in the now what has happened is that early in the current act we are having two provisions. One deals with MAT and the other deals with AMT. In the new bill, they have clubbed these both these provisions, and as a result of that, what is happening? A view is emerging that the AMT provisions might not apply to LLPs which are formed on account of conversion of a company into LLP. Now, as of now, it seems to be a drafting point just because the two sections have been clubbed together. But whether it remains in the same form and manner when the law gets enacted is something that we'll have to, only time will tell. Moving on to the litigation related update. As a concept, the litigation and tax disputes are conceptually similar in the sense. One important one is with respect to the GAR related point, which is in the context of reopening. Now, as we all know that in the current law also tax reopening is permitted if at all there are certain specified scenarios, there are enough checks and balances in the law. Under the new IT bill, what has been provided is that if a case has been referred to the GAR approving panel within the specified limitation period, then there will be no time restriction for issuing the reassessment notices, which are based on that GAR approving panel's directions. Now, this is an important one because under the current law also and in the new IT bill, there is a specified timeline within which the GAR, within which the reopening notices can be sent to the taxpayers if the tax authorities want to reopen a taxpayer's case. In the new bill, what has been provided that if the GAR approving panel has been referred within the specified timeline, then there is effectively an unlimited time period which has been provided to the tax authorities. So here it becomes important that going forward, whenever a tax authority will issue a reopening notice to the taxpayer, one will have to see and keep a careful watch on whether it has been issued within the timeline, whether it has been issued with the approval of the specified authority, and whether it is based on the directions of the GAR approving panel. Now, this might be an important change, but and therefore we should be careful and watchful of how the language emerges in the final version of the law. There's one more update in relation to dispute resolution panel. The new IT bill has mandated that the DRP issues the directions in writing. Of course, it states the point of determination, and they also provide the reason for their decision. So effectively, the law is requiring them to pass a reasoned order. A similar provision is there in the context of the first appellate authority, that is CIT appeals or the National Faceless Appeals Center. Moving on to the non-profit organization related taxation related amendments or the key updates which are there. Uh, as a concept, again, the non-profit organization related taxation provisions are in concept similar. That non-profit organizations are provided tax exemption status for their incomes, provided that they apply the same towards their charitable purposes, keep them invested within the specified modes and the prescribed modes of investments, and undertake the other related compliances. The problem that is happening in the current act is that the sections, provisions, and the implications for non-profit organizations are scattered in different places in the Income Tax Act. For example, there is a section 11, then we have a section 80G, and then there is a section 115 TD which provides exit tax. So to make it easy to comprehend and understand what has been provided in the new income tax bill is that all of those provisions have been arranged under one single chapter and making them easy to understand, so that anyone who wants to read and understand or interpret a non-profit organization taxation, they can open just a single chapter and see what is the relevant provision which is applicable to them. The second point in relation to ease of reference is that in the current version, if we see, we have got different terms like trust, institution, university, but in the new IT bill, they've used standardized terms like, only a non-profit organization. So going forward, we might be, referring in the general parlance to NPO taxation, because now that is a term which has been used in the new bill also. Again, with respect to codifying concepts, the new IT bill has codified certain concepts which currently are referred and used many a times in terms of interpretation. For example, the concept of corpus donation, what is the concept of deemed accumulation. So even in the current act, one would have given a meaning, the same meaning as it has been provided in the new IT bill. But again, just to ensure that there is no lack of interpretation or there is no interpretational issue or interpretational error, the new IT bill has provided the definitions for terms like corpus donation, regular income, deemed accumulation, and also provided certain clarity in relation to the commercial activities that can be carried out by a non-GPU NPO. A non-GPU would mean an NPO which is not there in the general public utility category. Overall NPO scheme, if one sees again, one more change is that whenever there is a change in objects, currently the law requires that they have to apply for fresh registration in case the change in objects does not conform to the conditions subject to which they were granted the registration. In the new IT bill, that specified language is not there, which is meaning that they have to apply for fresh registration in case of any change in object. Another update is that in the current law, if a charitable entity or a non-profit organization earns any capital gains, or that is to say, if it transfers a capital asset, it has been provided two options for applying its income. It can either apply it towards its regular activities, or it can use it to purchase a capital asset. Now, the option of purchasing a capital asset has been removed under the new IT bill, and the context or the rationale that has been provided is that the NPO can anyways use it towards its charitable objects and the regular activities, which will enable it to claim application of that particular income. Now, while it is good, but interestingly, what is happening is that in the current act, in the current regime, many a times you have seen that the non-profit organizations used to purchase mutual fund units or put the money in in FDs, because there was a circular which sort of gave them some relaxation that putting money into these assets would also qualify as purchase of capital assets. Now, with the going away of this deemed application on purchase of capital assets, it will be interesting to see how the NPOs actually navigate through this aspect of NPO taxation. The next update in relation to NPO taxation is that in the current act, an NPO is provided an extended time period if they want to accumulate their income for a longer period of time and want to apply that income towards their charitable objects in the future years. So in the current law, they've been provided an option of 5 years and also an option of 1 year. So while the option for 5 years is available, the option of accumulation for 1 year has not been provided. While on first principle this might look good, or one might feel that this is actually no negative for an NPO, but I think one will have to be careful in using this particular 5 year window, because in the 5 year window they have to specify the purposes for which they are going to accumulate. And I think now it will be interesting and very much important for NPO taxpayers to be careful when they apply for this extended time period as to what are they specifying that the purpose for which they are going to accumulate. Then I think lastly, one important update for NPO taxation is that how are the gains going to be computed from the permitted commercial activities or the income which is applied for related persons. The new IT bill has provided that a computation method will be prescribed. Now, this is an important aspect of non-profit organization taxation, because doing activities which ensure that income gets applied for related persons is sort of a negative for a non-profit organization, because what happens is that the income to that extent is not eligible for exemption. The question always has been that how do you compute it? The general answer has been that one has to do a fair value mechanism so that one ensures that there is no income or expense which is going to a related person. But how would one compute? Now the law has provided that a computation mechanism will be prescribed, which will ensure that there are no interpretation issues or there are no challenges as to how would one compute this particular income. Moving on to some other changes that we are seeing in relation to the language of the new IT bill. One is with respect to the definition of relative. Now, as we all know that Section 56 contains the anti-abuse provision of Section 56. It provides the transfers between relatives are not subject to the Section 56 trigger. The section itself contains a list of relatives. One category amongst those relatives is lineal ascendants and lineal descendants. Here the new IT bill has sort of amended the language or tweaked the language a little bit to provide that both maternal and paternal side people will be covered within the ambit of lineal ascendants and descendants. I believe this might be a good particular provision, and this is one aspect of change that we can see in the language. The second is the capital gains exemption, the rollover benefit. Now, currently also a provision is there which currently also provision is there that if a person sells or transfers long-term capital assets other than house property and invests that in purchase and in acquisition of a residential house property, the capital gains are not taxable. In that provision, there is a condition that this benefit will go away if the person acquires another residential house property within a specified time period. Now, in the current law, it is 1 year. In the new IT bill, this one has been changed to 2 years. So for 2 more years, the person will not be eligible to acquire a residential house property. In terms of M&A, as of now, as conceptually, it's similar. But one point is with respect to fast track demergers. So in the current law, also the demerger definition, which used to refer to sections 391 to 394 of Companies Act 1956. When we see the new IT bill, it also mentions the corresponding sections only, 232, 232. So explicitly, the section of fast track demerger has not been mentioned in the definition of demerger for a tax neutral event. But therefore, one will have to see whether fast track demergers will qualify for a tax neutral status or not. And with respect to virtual digital assets, as we know that there is a section 281 in the current law which prescribes that certain transfers can be void if there are pending tax proceedings or pending tax demands against a transferor. That section is applicable only if the subject of transfer of that particular transaction is certain specified assets. Virtual digital assets or crypto assets as they're popularly called, they have also now been specifically included within the scope and purpose of this particular section, which would mean that going forward, if a person is transferring virtual digital assets, then the buyer may require then the seller to furnish either a tax NOC or a chartered accountant certificate of report that we generally see in in transactions and deals. So while these were some of the other category and the changes with respect to the IT bill, there are some points which one would have thought might have been addressed with respect to certain legislative ambiguities that we generally come across. For example, the taxability of deferred consideration or contingent consideration. There is no, I mean, as we know currently in the IT Act, it is not explicitly provided when will the deferred or contingent consideration get taxed, what is the year, what is the computation mechanism. Second is with respect to family settlement taxation. As we know, this is pretty settled, but again, this is governed by judicial precedents only. It has not been specifically or explicitly provided in the income tax law. So we hope and expect that there is some clarity on family settlement taxation in times to come. With respect to stay of demand, so as we know currently, it is governed by the office memorandums of 15% and 20%. Uh, One would hope that this also gets codified in the statute book itself, because this is now a very important and a prevalent part of tax disputes, tax assessments, tax litigation, and which sometimes and many times leads to a discussion as to what will happen and how much amount has to be paid to the tax department. And I think one very important one, which is with respect to family trusts, that with the solely aspect, going forward, one hopes that that also gets uh, sort of clarified or changed or some any with a rational mind. So these were with respect to the points which one hopes gets covered in the next line of amendments or changes to the income tax law. I think, and with this, I will hand it over to Bijal for her thoughts on how one should navigate and transition to the new law.
Thank you so much, Raghav and Ritu, for your valuable insights. With this background, let us just see as to how the transition provisions would really work, as well as the way forward. So, one foremost, the fact is that the new tax bill is to apply only for the tax year beginning 1st of April 2026. The administrative as well as judicial proceedings under the old act will continue to be governed by the 1961 Act. Second important point to note is that under the current law, there is an exemption of a transfer of a capital asset by a subsidiary to a parent, provided certain conditions are met. In a situation where there is a violation of any condition, then to that extent, the tax incidence really arises when the original transfer takes place. Under the new bill, the tax incidence now seems to be passing to when the violation really takes place, which does seem to be, in line with the government's intention not to really have retroactive levy, as well as just to streamline and simplify the law in itself. Next, vis-a-vis refunds, any refund which is due under the old act and whether it can be set off against a liability under the new act has not really been dealt with. Seems like an obvious miss, and we are sure that there would be enabling provisions introduced for that, in the next draft, which really is rolled out. Vis-a-vis interpretation of provisions and the sanctity of judicial proceedings as well as CBDT circulars, which are binding on the government, all of these would be means of an interpretation, and to that extent, judicial proceedings as well as circulars, which have been provided under the 1961 Act, would continue to be relevant so long as the substantive provision vis-a-vis what they are governed by continue under the new income tax bill. The income tax rules of 1962, they can continue to be relied on under the new IT bill, unless, of course, new income tax rules are really introduced. Now, moving on to the way forward. The central theme of the income tax bill is extremely noble. I think, going by the OECD standards, where you do look at the taxpayer as well as the tax authority really as business partners. With that theme in mind, the theme of the income tax bill is trust first and scrutinize later. A very, very noble intention, and it would be great that it is actually executed in true spirit. When we're really looking at certain provisions, of course, the current status is that there is the first meeting of the parliamentary panel has been held, and it is expected that this particular bill will be enacted in the monsoon session of the parliament, which is held in July or August. There are repeals and savings provisions which would continue to apply vis-a-vis the new act. Including for assessments, reassessments, etc., vis-a-vis a liability arising under the old act. And to that extent, the rights and obligations would continue, for any taxpayer, which they have been provided specifically under the old act to carry over under the new act. Certain carry forward provisions under the old act would continue under the new act. So, to that extent, it seems that there is a clear intention to really make it simplified. Of course, as we all will appreciate, the Income Tax Act of 1961 has been a vast and voluminous legislation, and we do need to exercise extreme patience in the transition period from the 1961 Act to the new laws. So we should not really expect, no hurdles. One must also surely laud the government's approach that in promptly releasing the detailed FAQs in order to clarify the rationale behind several amendments to the income tax bill. In fact, in her first budget speech, the Honorable Finance Minister has stated the government's intent on trust first and scrutinize later. This is definitely a step in the right direction, wherein the government and taxpayers are seen as collaborators rather than adversaries. Of course, it's a mindset shift, so we should expect it to take a little time, but of course, the goal is there and we should be able to achieve it sooner than later. One, of course, hopes that the new tax regime brings not just a simplification of the legislation, but also a greater degree of cooperation and understanding between the taxpayers and the government. With this, we would like to thank our esteemed audience for a patient hearing, and we now open our webinar for questions. You can post your questions in the chat box, and we'll be very happy to address the same. We have one question, and maybe I will address that to Raghav. It seems like all was going well. We had the judiciary really rolling out, few of the best, judgments, which in fact the world over are actually, using in their own tax litigations. What was really the need to actually have a new income tax law introduced?
Sure. I think over a period of time, what had happened is that the Income Tax Act had become a bit complicated to comprehend, not just for the non-taxpayers, the taxpayers, but also for the tax professionals and the tax administration as well. A lot of those disputes used to happen with respect to the manner in which the provisions were worded. For example, a provision would find place in one chapter and its explanation could find place in some other chapter. All of this led to some disputes, avoidable tax disputes, and therefore, one conscious attempt that the government has said that they wanted to make is to ease out the disputes, make it lucid, simple, and concise, so that the tax professionals, taxpayers, tax administration, and the judiciary find it sort of relatively easy to comprehend. Of course, there are, I mean, while the word count has reduced by half, but still it is a very big a draft statute, because it provides not only for levy of tax, but it also provides for other aspects like, tax administration, tax assessments, compliances, procedures, what will be the penalties, etc. So yes, an attempt has been made to make it half, to reduce it, but the reason was to make it easy to understand, lucid, and sort of simple, so that a non-tax professional or a normal taxpayer can also understand the tax law when it opens the statute book.
Thank you so much, Raghav, for the detailed explanation. Our next question is on treaty interpretation. And this question is for you, Ritu. Will the amendments to the provisions related to interpretation of treaties vis-a-vis terms not really specifically defined apply retroactively?
What the government, so that's really not I would say that's not a real change that the income tax bill is bringing about compared to what we have under the Income Tax Act. Income Tax Act, similar provision also says that if a term is, let's say, defined by a specific notification issued by the government, then it will take effect from the date the tax treaty came into force. So the income tax bill has not really departed from this concept. There's no departure there. It also says that if you borrow a definition from any other central laws, then it will take effect from the date the agreement came into force. And I think this not being a substantive change to the tax provision, government stand could be that they are just clarifying that if a term is not defined, you borrow it from other legislations. And in that case, it takes effect from the same date the agreement came into force. So strictly speaking, it shouldn't be seen as a retrospective amendment, but more in the nature of a clarification, and they're making it in line with the date or the point in time when the tax treaty came into force.
Thank you, Ritu. Yes, that definitely seems to be a point where it's not really going to hurt a taxpayer. It's in fact only going to clarify and simplify any sort of a judicial proceeding which a taxpayer may be subjected to. Moving on, we have another question for Raghav. And are there any changes in the corporate tax rates? Or any change in the tax rates applicable for individuals?
So as such, the new IT bill, the Income Tax Bill 2025, does not bring about a change or change any construct of the tax rates. And essentially that's because that's the intention and the objective, that they said that they're not bringing out any substantive change, they're simplifying it. So as such, no change in the tax rates construct.
Okay. And Raghav, we understand that there has been, some perhaps miss on the transitional provisions vis-a-vis business losses for the year 26-27. If you can just touch upon that.
Sure. So in terms of the capital losses, the current law also provides that a long-term capital loss can be set off against long-term capital gains only, whereas the short-term capital loss can be set off against either a short-term capital gain or a long-term capital gain. Now, this particular construct has been retained, but when we talk about the transitional provisions, because of the manner in which the provision is worded, it is appearing that if at all a person has unabsorbed long-term capital losses also, when the new bill comes in, when it becomes a new law, that particular unabsorbed loss seemingly can be set off against either a short-term capital gain or a long-term capital gain. Now, this is because of the manner in which that particular provision is worded. It's for the transition side. Now, we have to see that when the transition provision is finalized, whether it remains in the same form and manner, or whether they sort of plug this aspect.
Thank you, Raghav. Ritu, a question for you. Has there been, with the entire Pillar 2, etc., really being the talk of the international tax community, how would you see India really reflecting on the Pillar 2, and whether there has been any discussion on that in the in the bill?
So that's an interesting question and very relevant in current times. But so far, we have not seen government taking any tangible steps in that direction. In the last finance bill also, there weren't any specific announcements made or any roadmap announced. Um, in the income tax bill also, there is nothing which is very specific to it. Maybe because the government's focus has been on simplification of the existing law, which has been in existence for 60 plus years. So they have achieved this in a time bound manner, which is worth appreciation. Maybe now, once all of this is done, we have the new income tax bill in place. One could expect specific announcements where government would want to align income tax laws with how the Pillar 1, Pillar 2 global developments are taking place.
Interesting. And of course, it really, is an interesting situation as to whether India really needs to implement Pillar 1, Pillar 2, given the fact that we do not really have a minimum tax, below a 15%. So what would be the motivation is, of course, a big question mark. Raghav, you made an interesting point on, intercompany dividends. And if the amendment under Section 80M is not a typo, how would you advise, groups, in order to ensure that there are no tax inefficiencies while upstreaming dividends?
Sure. So, and I think this particular sort of change in language has become the talk of the town when people at about the new income tax bill. First is that this particular adverse impact will occur, I believe, when an intermediate company will be upstreaming to the shareholders. If at all there is a structure in which the intermediate company is planning not to upstream, then for them there is no change because they're anyways not taking the benefit of a Section 80M. Otherwise, I think there should be a two-step process that that people should undertake to navigate through this amended language. One is that all the existing group structures they should be closely evaluated whether there is a need for let's say an unnecessary or avoidable holding company. If at all that is not there, then it should be identified. Second is with respect to the AMT provision also, they should be identified that okay, how many partnership forms, LLPs are there, and then the second stage would be understand evaluating other options, for example converting into, I mean, I'm just something that comes at the top of the mind is maybe a conversion to LLP, or for example if there's a company which is not needed and which is sort of causing this tax inefficiency, whether it would be beneficial to sort of collapse the structure, evaluate a merger, having of course subject to appropriate and satisfactory commercial rationale. So these are some of the options which people should sort of keep on thinking and identifying, because even though the new law will come into force still after some period of time, but one should sort of use this time period to ensure that the change in law does not lead to any tax inefficiency. They should evaluate the holding structures and sort of identify which will be the most feasible and the most appropriate step or the structure that they should implement within their applicable setup.
Thank you, Raghav, for the comprehensive response. Ritu, a question for you. There would be, capital losses perhaps in the, previous year, 25, 26. How would you see these losses being carried forward, for the year, for the tax year 26, 27? It's going to take us time to also get used to speaking these concepts and speaking this terminology. So it'll be interesting to see, because in most situations you would see the provisions really being prospective and you don't really have an overlap with the old law. But vis-a-vis carry forward, there will be an overlap for the 1961 Act with the new law. And how would you really see that being carried forward vis-a-vis the transitional provisions?
Sure, thanks, Vijay. So when we look at capital gain losses, which let's say a taxpayer has accumulated under current law before income tax bill comes into force, versus let's say business losses. So the set of rules with respect to business losses and capital losses are different. When we look at business losses, there's no real difference. The remaining or the losses which are unabsorbed will be available for set off for the balance period. So we have an 8-year window within which business losses can be carried forward and set off. So if 4 years have already passed under current law, then the business losses will be available for the remaining period under the income tax bill. When we look at capital losses, the current law says that long-term capital loss cannot be set off against short-term capital gain because both are taxable at different rates. The transition provisions, as per the bill, they somewhere, again, it could be a drafting issue, but as per the transition provisions, the reading is that long-term capital loss can also be set off against short-term capital gain to the extent it's falling within the scope of the transitionary provisions. So there is difference there in terms of what is allowed under law versus what is captured under the transition provisions. So I think it remains to be seen again if it's just a drafting issue or they actually intend to provide this additional benefit in the interim during the transition phase.
Interesting. Thank you so much, Ritu. One question for Raghav, and Raghav, since you do so many restructurings for Indian corporates, I think there has always been this question with respect to the Section 29, the prohibition of carry forward of losses, if at all there is a change in, shareholding. Has the new income tax bill really provided any relief in the way you actually look at the beneficial ownership really changing?
So I think conceptually there is no change. Carry forward of losses is still going to be prohibited if the shareholding changes beyond the prescribed permissible range. But there's one point I think that we should definitely do a careful deep dive analysis because the new section language has been tweaked a bit, and the tweaking has been to the effect that they are now using the concept of beneficial owner instead of beneficially held. So therefore, whether this particular tweaking of language, change of word will sort of lead to any other implication is also something which one will have to be very careful in evaluating whenever there's going to be an M&A deal. But I think that being said, there is one other interpretation issue also which we often come across is that whether one should look at a direct shareholding change or an indirect shareholding change. I think that has still not been explicitly addressed. But yes, the change of terminology from beneficially held to beneficial owner is might be an important one. So therefore, we have to be very careful whenever there is a M&A deal or a deal which involves a loss-making company.
Thank you, Raghav. With this, I know there are a number of questions still pending in the chat box. Would sincerely request the participants to really reach out to us directly, given the fact that we are out of time now. Thank you so much for a very patient hearing, and to our excellent panelists, both Ritu and Raghav, for the very detailed discussion. Thank you so much.
Thank you so much.
Thank you.